everyone. If you can hear me, just if you don't mind typing in the chat box in the lower left-hand corner of your screen that you're able to hear us, that would be great. We want to make sure that everyone's able to hear us before we get started. And we're on a new mic system, so we're just testing it out. Perfect. Thank you. Appreciate it, Debbie and Becky. We will wait just maybe 30 more seconds or so for anyone who is maybe running a little later than normal, and then we will get started. So hang in there. All right, we will go ahead and get started. Thank you guys for taking some time out of your day to attend our little private webinar. I know that Vern appreciates it as well as ourselves. And so before we get started, I just wanted to touch base. If you guys have any questions, we ask that you hold it on till the end, and then you can type it in that chat box on the lower left-hand side of your screen. We may be able to answer some of your questions as we go through each slide. So if you want to hold them until the end, that would be preferred. If something's urgent, we will do our best to address it and incorporate it into the presentation. So we'll go ahead and get started. All right, so our presenter today is Adam Long. He's our National Account Executive. He's been with RAC for over 9 years. Natalie Torgman is our USDA Division Supervisor. She will be touching base as well on a lot of your questions probably. She's been with RAC for 7 years. And then myself, my name is Kelsey Schmiegel, and I am the Digital Marketing Specialist, and I have been in the industry for 6 years. So we're excited to be here with you today, and hopefully you guys get a lot out of this. So before we get started, let's jump into some of the main points on the agenda of what types of topics we'll be touching base on throughout the presentation. We'll go through regulations and guidelines, property eligibility, income eligibility, qualifying income/repayment, standard purchase, refinance programs, repair escrow, and then we'll dip a little bit into manufactured homes, and then provide some helpful USDA documents and links to those. And then last but not least, we'll provide our contact information so you'll have it on hand, and we'll jump into the Q&A on that slide as well. So let's go ahead and get started. I'll pass it over to Adam and Natalie.
Hello, everyone.
Hey, guys.
I'll just read through this, and if I have to defer to my underwriter here, Natalie, I shall. So here we go. Regulations and guidelines. There's a couple links right here that we listed for you. These are just for finding out the reg, if you want to go there and get all the regulations. We'll get to these other websites later that you can go for eligibility, but for the main part, these are strictly for regulations, okay? So you can visit them at any time, and I'm going to skip on down to the bottom. Here we go. RAC will accept any ratios that GUS will issue a GUS accept on. Typical ratio limits for a GUS accept are 33 on the front, 45% on the back. You start getting over that, you may get an ineligible due to excessive ratios, regardless of the strength of your file. On the flip side of that, you have your GUS refer, okay? And if you do get one of those, the ratios are strictly capped at 29 for your housing ratio and 41 on the back for your total monthly debt obligation ratio. 29.01 doesn't work. It's 29.00, and same for the back, 41.00. We will go down to a 581 on all USDA loans. You're guaranteed to get a GUS refer. Anything under 640 is guaranteed a GUS refer. It doesn't matter how many months reserves you have. So just keep that in mind. And, well, there are no reserve requirements, of course. However, sometimes if they happen to have a couple months reserves, it does help us, because if you're above a 640 and you're still getting that GUS refer, by putting some reserves in and rerunning it through GUS, it could possibly flip it over to an accept, which would obviously allow your borrower to qualify for more of a home. So just a little tidbit of info there. Moving on to property eligibility, okay? Of course, all subject properties must be located in a USDA eligible area. Here's the website right here. You can check the subject property locations at this website. If you don't, you can actually type, if you have a subject property, you can type it in the geocoder, and it'll tell you this property is eligible or it's not eligible. If you don't have a property and you're just curious about certain areas that are eligible for USDA financing, it gives you a huge map and it's color-coded. It's shaded in different colors. It's either eligible, as you can see on the screen there, or ineligible. Okay? And I want to talk about refis real quick. So say you did a refinance, you did a purchase on a USDA loan 5 years ago or whatever. And at that time, the property was located in an eligible area. Well, now the population census was updated, and a lot of eligible areas that were once eligible have now disappeared, and they're ineligible. However, because you were eligible at the time of the purchase, you're grandfathered in. So if you want to take advantage of one of the USDA refinance programs, you can, regardless if you're eligible or not anymore, or your property's in an eligible area. So moving on to the next screen, income eligibility. Okay, so here's how, this is the big, we want to separate eligibility income from qualifying income. So let's talk about eligibility income. This is, annual income is used as the basis for computing adjusted annual income and is based on anticipated income for the coming year, projected income. Income from all adult household members, not just the parties to the note, must be considered when computing annual income. This income calculation is utilized to determine eligibility of the household for the single-family housing guaranteed loan program. As of December 21st, 2017, all adult household members are no longer required to execute a 4506T. And that means obviously no transcripts. So that's a big plus. Therefore, USDA is the only government program that does not require tax transcripts. Chapter 9 of 7 on the Code Federal Regulation 3555 outlines in more detail what types of income will and will not be considered in the computation of annual income. All dependents under the age of 18 years old will have a credit of $480 per child given as a deduction toward the annual household income calculation, which means if your household income is just a tad over the income cap for that specific county and you have, say, 2 kids, you can deduct $960 from that. And that may put you under the cap. So it's kind of, if you have 3 kids, it's, it's 480 times 3, which is
1440.
1440, Anyway, so you get my point. All right. Child care services is a good one. So if you take your kid to daycare and you can produce a monthly, weekly invoice, we can, if you're spending $175 a week, we can take that times 52 weeks divided by 12, and you can actually back that out of your eligibility income if you happen to be over the cap. We can use private child care. So if you have, like, Mrs. Smith down the street and you're taking your kids there, and if you're paying her on a weekly basis with check, we have to be able to source it. We can take that into consideration as well for child care. Moving on. Let's move on over. Let's talk now. Here's qualifying income for your debt ratios, okay? This is what we're going to qualify your borrowers on. Lenders use repayment income to determine whether the applicants have sufficient income to repay the mortgage in addition to other recurring debts. Repayment income often differs from the calculation of annual income and adjusted annual income used to determine if the household is eligible for single-family housing guaranteed loan program. To compute repayment income, the lender must count only the stable and dependable income of persons who will be parties to the note. Co-signers, or non-occupying co-borrowers, are not permitted in the single-family housing guaranteed loan program transaction and are not an accessible source when considering repayment income. So what I'm trying to say is any co-borrower must live in the household. Stable and dependable income is determined by the types of income that has been earned for the previous 2 years. And we're going to move on to qualifying income continued. If there are any gaps in employment within this 2-year work history, USDA will allow, for certain circumstances, to qualify the applicant with less than a 2-year work history. You want to talk about?
Sure.
We'll talk about that.
Like I said, there are certain circumstances that are allowed. So if you have a mother that had to take some time off of work to care for minor children, that's an acceptable circumstance. Extended medical illnesses are also acceptable. If they went to school to better their career, and we can prove that with tax transcripts, and now they're working at a recent job, they just started in their line of work, we can use things like that. So, like I said, under extreme circumstances, less than a 2-year work history is acceptable, but we definitely have to be sure we can document the reason why.
And I think Nazzy meant school's transcripts. We don't need tax transcripts.
Oh, yeah, school, I'm sorry.
I just want to throw that out there if you guys get concerned. Anyway, then this is another good thing. This is specific to USDA as well. Social Security or any or non-taxable income can be grossed up automatically by 25%, regardless of any tax tables or percentages of taxable income. You know, on FHA, most of the time you fall into the 15% or sometimes even the 10% gross up tax table. So 25%, and I think Nazzy will allow you to gross up.
Yeah. We'll gross up child support, we'll gross up any, like I said, any non-taxable income. I mean, if we can qualify the applicant without doing that, then I'll try to do that first, but if we need it, I'll use it.
Yes, and also if you're using any type of alimony or child support, we need to see a solid, documented 12 months of the mandated amount being received by mom or the ex-wife, whichever. Okay, or dad, child support. Okay, as with annual income, USDA suspended the need for the executed 4506T. Again, therefore we don't need any tax transcripts for the repayment income. Now, I'm going to talk about that. We'll take the 1040s though. We just don't need you guys taking that extra step and executing the 45, or executing the 4506T. All right. So moving on to standard purchase transactions. Principal residence. Applicant must agree and have the ability to occupy the dwelling as their principal residence. The agency may require evidence of this ability. Rural development will not guarantee loans for investment properties or temporary short-term housing. The adequate dwelling. The dwelling must be modest, decent, safe, and sanitary. Okay. Eligibility of current homeowners. Current homeowners may be eligible for guaranteed home loans under this part if all the following conditions are met. Okay, so basically, if they already own a home elsewhere, and as long as that mortgage, well, it can't be a USDA loan. So if they have a mortgage somewhere else on another property, they can retain that property if the applicants are not financially responsible for another agency guaranteed or direct home loan by the time the guaranteed home loan is closed. The current home no longer adequately meets the applicant's needs, meaning if you have a single man and he married a woman that had 4 kids, now you got the Brady Bunch syndrome. You might have only had 2 bedrooms. Well, these kids, and you need more space. I mean, you got to have more bedrooms. So that's one of those. If the house is obviously, let's call it not safe. If it's falling down around you, dilapidated, that's another reason. What's any other reason? Oh, if you're moved, okay, so say you get relocated for work outside the local commuting area. I think is there like a mileage in that, 100 miles or something?
I think that would, we would typically want to see maybe 40 miles more out than where the subject property is. There is no mandated distance. It's what the lender deems to be outside of the local commuting area.
So that'll be up to Nazzy. Okay. And the applicants will occupy the home financed with the single-family housing guaranteed loan as their primary residence. Okay, so we're not going to let somebody exploit the program to buy an investment property. Okay, moving on. Standard purchase continued. All right. The applicants are without sufficient resources or credit to obtain a dwelling on their own without the guarantee. Okay. No more than one single-family housing dwelling other than the one associated with the current loan request may be retained. The applicants must be financially qualified to own more than one home. In order for net rental income from the retained dwelling to be considered for the applicant's repayment ability, the consistency of the rental income must be demonstrated for at least the previous 24 months. Or demonstrate the current lease must be for a term of at least 12 months after the loan is closed. Okay, moving on. So here's some benefits of the USDA program with Residential Acceptance Corporation. Number one, like I said earlier, we'll go down to a 581 with no overlays. We do underwrite to the USDA guidelines, so we're not going to be adding in our overlays or anything like that. This is a big one for your refer people. We accept rent-free letters in lieu of a VOR. So if you have a borrower that is living at home, trying to save some money, we're not going to ask for verified rent. We can actually get a rent-free letter written by the persons that are permitting your borrower to live rent-free. Manufactured lending, of course. We can finance up to the appraised value. Excess funds can be used for closing costs. No down payment is required. 100% financing. And 24-hour underwriting. Finance, this is the one I want to talk about. Most people ask me about rolling closing costs into the loan. Or, you can do that if the appraised value comes in higher than the purchase price. Let's just say it's a $100,000 purchase price and the place appraised at 106, and your debt ratios permit you to increase the loan amount. You can essentially roll in $6,000 worth of closing costs. Okay, so the purchase price will always remain the same, but you can bump the loan amount to absorb any closing costs that aren't covered by seller concessions. So that's a big thing. And you can also use that money to help recuperate any monies that the borrowers have invested in the transaction, such as EMD and appraisal costs, things like that. So you can get these people into these houses no money out of pocket, and you get them a check back at closing. Okay, I'm going to flip the page here. We're going to talk about some refinance programs. USDA refinances loans allow existing USDA direct loans and USDA guaranteed loan borrowers to refinance at lower interest rates, meaning there's no cash out, they're basically rate and term. Homeowners with an existing USDA loan can take advantage of special refinance options and potentially obtain a new USDA refinance loan at a much lower interest rate. Benefits of USDA refinance with RAC. Quick and simple refinance programs with limited documentation, such as you have the Streamline Assist refi, which was formerly known as the Pilot refinance.
And if I may jump in there with this one, this is a really good program because this one has no credit and no DTI cap, as with the other two refi loans. We don't need an appraisal with this one as well. So basically, as long as your borrowers have been making their payments on their mortgage on time for the previous 12 months, then regardless of what other debt they have, regardless of whatever their credit score, they'd be able to qualify for this particular refinance transaction.
So the credit report, you could pull a mortgage.
You could pull a mortgage only. I mean, you can give us the credit report, but the only thing that we're going to concentrate on is, and underwrite to, is the mortgage credit, trade line.
Yeah, and also we do need a credit report for pricing purposes. So we need the credit score. So, but like she said, even if you give us a full credit report, we're going to look at the mortgage history. If they got collections and they paid a car payment late in the last 12 months, we're going to kind of turn a blind eye to that.
That's none of our concern. We're just focused on the mortgage.
As long as they're paying their mortgage, that's all we care about. Obviously, once again, we have a streamlined refi.
Yep, that's the other one.
Okay.
That one is capped. That one does have to qualify under Chapter 10, which is the credit section, and it also has to have a max ratio limit of 29 over 41.
Okay, yeah, because they're all
They're all manual underwriting.
We don't use GUS. We don't utilize GUS really for refinancing.
Right.
So they have to adhere to the manual underwriting debt ratios. Down to a 581, once again, and 24-hour underwriting. Okay, here's a cool one. Repair escrows. One of the repair escrow programs that I actually can tolerate. All right. So USDA allows repair escrow loans where the appraisal value comes back subject to the following repairs when the appraisal does not meet required HUD Handbook Guidelines 4000.1. The word repairs is important because the program cannot be used for structural improvements or repairs that deem the home uninhabitable. Sorry, that's a little typo there. Well,
no.
We fixed it. Okay, great. Uninhabitable. All right. So benefits of the repair escrow. So RAC will finance 100% of the estimated repairs at the closing, given there's enough equity between the purchase price and the appraised value. So what that means is it is contingent on the appraised value coming in higher than your purchase price. So just like I mentioned earlier, instead of rolling in closing costs into the loan, in this case you'd be rolling in repair costs. Repairs are limited to 10% of the total loan amount. So obviously that's determined off the size of your loan, how much you can use for repairs. And again, there you go, down to 581. We're going to drive that one home today with no overlays. And moving on to our manufactured home guidelines. USDA will allow the financing of the purchase of a new manufactured home, as long as the manufactured date of the unit is dated within 12 months of the purchase agreement. The site and unit must both be part of the collateral. Loans without the site, without like a piece of property to put them on, are ineligible. Appraised value must support inclusion of full price or any remaining balance of the lot or site loan that may apply. Manufactured housing units must have a minimum of 400 square feet of living area. The unit may be a single or double wide. There is no restriction on the unit type the applicant wishes to purchase. The unit must meet the Federal Manufactured Home Construction and Safety Standards. USDA also has launched a program, it's a pilot program, allowing the manufactured lending for the states of Louisiana, Ohio, and Texas. These files must be manually underwritten. There's zero down payment needed, but those are existing manufactured homes that were manufactured in 2006 or newer, or more recent. So anyway, and also we on our website we do have a page. It has links to our USDA documents. As you'll see there, manufactured home lending, loans, just you can click on all those for some information or to get any type of lender-specific disclosures or forms that we do have. And then you see our last page. That's our contact information for all of us here.
Fantastic. Thank you so much, Adam and Natalie. All right, guys. Well, we hope that you found this webinar insightful and useful for any future questions, or maybe we've answered them along the lines throughout this presentation for you. If you have any questions, we're going to go ahead and open up the form. I see that, Stacy, you had already asked a question. Would you be able to please send a copy of the presentation? Yes, I will be following up with everyone who is in attendance today later this afternoon before the close of business today, and I will send you the link. And if you have any questions, you'll have my email is on there. It's on the screen as well, so you'll be able to easily access us. So something else too is that we do have a pre-qual program while we're waiting for more questions to come in. So please remember, if you want to see if a loan is doable, just send us the 1003 and the credit report to pre-quals with the S at recmtg.com. This is free of charge for you, so it's we try to simplify the process to make it efficient for both of us, and we'll let you know if it's doable within 24 hours. Okay, so I see that Todd has a question. Just so that I'm clear, you guys are saying each child has a yearly allowance of $480.
That is correct.
That is correct. It's
Or is that monthly?
No, yes, it's yearly.
It's annual. So if you have your growth, you figure out your eligibility income. So you come up with like $83,000 is what the projected income is for the home. You would simply subtract $480 from $83,000.
Right. So typically a 1 to 4 person household has an eligibility cap of $78,000. I want to say 200.
Yeah.
So if you exceed that and you have 2 children, you deduct $480 per child from that annual income, and that will be the adjusted annual income.
Yep.
Awesome. And okay, so the next question from Debbie. Thank you for that, by the way.
Mhm.
I hear maps are changing this month for eligibility. If we have a file in the pipeline and the map changes and the home is no longer in an acceptable area, what happens to the loan in the pipeline? Do we have a 45-day grace period to close these loans?
I'm pretty sure, and I will do more research for you, Debbie, but I'm pretty sure we need to have a conditional commitment issued prior to the effective date of the new map. So if we've got something in an eligible area and it's, it's taking precedent, I'll definitely make sure that we get that loan closed before those maps become effective. But I'm pretty positive usually when any new regulations come into play, all they're looking for is to get that approval issued by USDA, and we can close it whenever at the time after.
Fantastic. Will asks, are we able to get to brand the presentation? Yeah, well, if you want to touch base with me, Kelsey, after the webinar is done with, our team can definitely handle any white labeling for you. So let's touch base after the presentation, and we can certainly cater to your needs there. Okay, Will says the 480 if needed, and it does not put over income, correct?
480 will be deducted regardless because we need to know the number of persons in the household. So if we see that children are there, we're going to deduct it whether they need it or not.
Perfect. And then Debbie asked, when are the maps changing? Is it truly this month?
Not know for sure. I'll double check that. Yeah, I'll double check. I have a contact over in Washington, D.C. that I'll check with her. And so hopefully we can get a date. I know they were discussing in December about changing the maps and holding, what are those meetings, the township meetings and things like that. So I'll definitely get a date for you guys.
Fantastic. JP is asking, where do we verify the income threshold?
Through the eligibility website that we issued on the property eligibility page, there you'll be able to access whether the property is located. You'll be also able to select whether the income is eligible. If you want to navigate over to that website, you'll be able, if you have any issues with that, you can always contact us.
It'll ask you, you'll go in there, hit income eligibility, it'll ask you for what type of program. Well, actually, it won't ask you for the program, it'll ask you for the state, then it'll ask you for the county, and you'll be able to fill in like what the monthly income is, how many children are under the age of 18, if there's any elders in there over the age of 62, anything like that, and it'll tell you whether it'll kick up a final screen. It'll say you're eligible for the guarantee program, but ineligible for the direct. Okay, and the direct program. We really don't mess with the direct program. The income limits are so darn low. I mean, it's just a guaranteed 502 guaranteed. That's what you have to be concerned with.
Great answer. Thank you, guys. If you guys do need our direct number, I know, Will, you're asking for it. Our emails are on the screen right now, and if you need to contact us, just call that 813 number at the top, that first or second bullet point there, and our receptionist will send you over to us. So it's not like we are a huge banker here, so we are able to speak with you one-on-one, which is kind of what separates us from others, which is fantastic. So don't worry about the direct number. Our receptionist will take care of you and get you to us. Any other questions that we can maybe answer at this time? We'll wait a few moments.
Thank you.
Thank you, Will. Todd Haynes wants to know mortgage history.
Can we get a little more specific?
Like refinance?
If they are current the prior 12 months but have multiple rates.
As long as the last 12 months is...
If you're talking about a refinance, yes, I would say as long as the last 12 months were clean. If we're talking about a purchase and they currently own a dwelling, we, really all derogatory credit should be cleaned up 12 months prior to application date. So we will consider it, but also make sure that if they're retaining the dwelling, they meet that standard, that was the slide that we went over about a current homeowners and all that jazz. There are multiple other areas they need to qualify for.
Awesome.
Yeah, all derogatory credit with USDA needs to be cleaned up 12 months prior to app date. There are exceptions when it comes to medical and things like that, but like if we're talking about a mortgage, you definitely need a clean 12-month history.
So if the borrower has 630s in 2015, but none in 2016, then they are good.
Oh, absolutely. Yeah, yeah, no question. Natalie can work her magic.
Yeah.
All right. Any other questions we can answer at this time? I don't want to keep you guys, but I definitely don't want to rush if anyone has any questions. If you guys think of any other questions, feel free to, like I said, shoot us an email or give us a call. We're always available. Oh, looks like we may have one question. We hope this was very insightful for you guys. We enjoy doing this as much as hopefully you guys enjoy listening and learning.
Yeah, if you guys have any other specific topics which you wanted us to touch base on, just let us know. We'll make another presentation for you guys.
Linda says, thanks, there's hope for my single mom client.
Oh, yay.
Can you send out a ticket? Yes, Vern, we're going to send out this whole webinar after, like I said, before the end of the day today. So I'll be following up with everyone in attendance, and you'll get the link. You're welcome, Debbie and Todd. There may be one more question coming in.
All right, cool.
Oh, you're welcome, Vern. All right, if you guys think of anything else, feel free to shoot us an email or give us a call, like I said. And if there may be one more question. I don't want to cut it off too much. The 203K program for FHA.
Yeah.
Okay, we can do that. That's a really good idea as well.
Shoot an email to Adam.
Shoot an email to Adam about that, Will, if you don't mind, and we can work together on that and get something going.
Or maybe he wants to do the presentation for the repair escrow for USDA. I mean, it's not really a 203K, but it's almost the exact same thing, but USDA, yeah. So maybe we'll do a presentation for that 203K, because it can't get tricky.
Sounds good. All right, guys. Well, thank you so much, and we hope you enjoyed it, and we will be touching base soon. You're welcome, everyone. Thanks for joining. Have a great day.